Okay, another topic that I want to address in Chapter 6 is this idea of operating leverage, because it's really useful and handy. So let's look at two companies to get a better idea of what operating leverage is. So let's say we have firm A and firm B, and we're going to use a contribution format income statement, right? A CVP analysis, which if you've done it enough times, by the time you get to this, right, we know it's sales minus variable costs gives us our contribution margin minus our fixed costs gives us net operating income, right? And the whole purpose of this kind of analysis is that it's easy to use and helps us predict for the future. So let's say that company A has $50 in sales, $10 in variable costs, which leaves us 40 contribution margin, 30 in fixed costs, and then a net income of $10. Okay. So ratio-wise, right, what do we have going on here? Our contribution margin is 80% of our sales, right? And our variable costs are 20% of our sales. So out of every dollar in sales, 80 cents is going to contribution margin, okay? Let's compare that to Company B, and we're going to say Company B has the same amount of sales, but their cost structure is different, right? So they're going to have 25 in variable costs, leaving 25 in contribution margin. So, right, their variable costs are 50% of their sales. Out of every dollar in sales, 50 cents goes to pay their variable costs. And 50 cents goes towards contribution margin. And then to keep things even, right, we're going to say their fixed costs are 15 so that they also have a net income of 10. Okay? So, if you remember from your reading, right, the degree of operating leverage is contribution margin over NOI. Okay, so let's just look at the numbers and then we'll talk about what they mean. So our contribution margin for firm A is 40, and our NOI is 10. This gives us 4. Over here for company B, contribution margin is 25, NOI is 10. This gives us 2.5. So the higher the number you have, the more leveraged you are, right? So firm A is more leveraged. And what that basically means is that their cost structure is more heavily weighted towards fixed costs, right? And we can see that that's true. Their fixed costs are significantly greater than their variable cost, as opposed to the opposite being true for firm B. And so when you have a higher degree of operating leverage, you're in a more risky position, right? So firm A, regardless of how much they sell, they're going to have to be able to pay their $30 in fixed costs, right? Same with B, but theirs is much lower, right? They only have to pay $15 of fixed costs. So as sales are declining, firm A is in a riskier position than firm B. But that being said, right, we use leverage for a reason. As sales increase, right, who is going to profit more? Well, once you've hit break even, right, so once they achieve this and this, firm A is going to be in a better position, right, because 80 cents on the dollar, right, is going to go directly to net operating income. Whereas for firm B, only 50 cents on the dollar is going to go to net operating income. So while this number indicates that this is more risky, they have a higher upside as well. So what this number tells us, the 4 and the 2.5, is that for every 1% increase in sales, they're going to have this number increase in NOI. Okay. So let's just see how that works. So let's say for firm A, let's look at a 10% increase in sales. So I'm just going to do this quick and dirty down here. We'll just make sure that it works. Right? So for firm A, apologize, this got a little messy. For firm A, a 10% increase in sales, right, is going to give us $55. right? I don't really need to do all the math. Contribution margin, right? These ratios don't change unless I tell you that they do. So if I take 80% of the 55, that gives me my contribution margin. So 80% times 55 is 44. So I know that this is 11. Remember, my fixed costs don't change. They're fixed. And so my net operating income becomes 14. For firm B, right, this also becomes 55. And my contribution margin is still 50%, right? These ratios don't change. So 55 divided by 2 gives me 2750, right? My fixed costs are still 15, so that gives me 1250. Okay. So by how much did my NOI increase, right? It went from 10 to 14, right? It went up 40%. So the 4 is the percent increase if sales go up 1%. If sales go up by 10%, right, it's 4 times 10%. So my NOI went up by 40%, right? 10 times 40% gives me 4, right? And 10 plus $4 gives me 14. Same thing over here, right? My NOI went from 10 to 1250, right? So it went up, right? 2.5 times 10% gives me 25%, right? And 25% of 10 is 2.5, okay? So hopefully that helps clarify operating leverage a little bit more.